All right, options traders, listen up. I want to tell you a bit about public.com. But first, have you ever actually thought about all the fees you're paying to trade options? Aside from the regulatory fees, there are commissions, and most platforms charge per contract fees too. That's what makes today's sponsor, public.com, so interesting. Public doesn't charge commissions or pre-contract fees. And in an industry first, they offer a rebate of up to 18 cents per option contract traded. Check it out. If you trade 1,000 option contracts on Public, you'll get up to $180 in rebates. If you trade 10,000 contracts, you could earn almost $2,000. More importantly, the rebate means you can maximize your profits and minimize your losses. So to recap, no commissions, no per contract fees, and up to 18 cents on every contract traded. See why NerdWallet recently awarded Public 5 stars for options trading, and start earning up to 18 cents per contract traded only at public.com. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures in podcast description. U.S. members only.
Hey everybody, welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. I'm Jason Hall, joined as almost always by he who is the voice of the people, my dear friend Jeff Santoro. Hey Jeff.
Hello. How are you, sir?
I'm great. I'm wonderful. I'm almost completely back.
You know, it's funny. We recorded the last episode a week before it went live, and I was listening to it the day before it went live. And even in that, whatever it was, week-long span, you had gotten so much better. So yeah, this is a big improvement from the last recording we did.
It is. It is. Well, so this is an interesting thing. The show that we're going to do today is actually really related to the last show that we did, which was one of our kind of more organic conversations that's pretty broad and wide ranging. But we decided we wanted to do something that was kind of in the same vein, but was a little more focused. And this show is titled, this is again a working title that's probably going to be the final title, 3 things to know before buying your first or your next stock.
Yeah, maybe we should just decide on the titles before we record, so we don't keep saying it's a potential working title.
That's a terrible idea. We're not going to do that.
That would be too scripted. That would be off-brand.
It is, and we're not investing scripted.
No.
So
yeah.
See, now I'm saying the thing out loud, so I'm not going to say anymore. Jeff, housekeeping us, please.
All right. Thank you to the people on Spotify who continue to give us ratings. We really appreciate that. We need the Apple Podcast listeners to step up and do the same.
Entitled.
Yeah, seriously.
Apple Podcast.
Come on, Apple people. And obviously ratings and reviews are super helpful to help people find the show. The newest thing I want to just remind people of is we have a portfolio up on savvytrader.com. You can just search for Investing Unscripted on that platform, or also there's a link in the show notes where we have a portfolio we put together that we're going to add to each month with commentary on the picks we make. It is a subscription thing, so if that's something that's interesting to you, please check that out. And other than that, keep sending us feedback, questions, ideas for the show. We really appreciate all the interaction with folks on any social media app or email. All right, Jason.
I want to say one thing real quick about the Savvy Trader portfolio. I've started kind of playing around with it a little bit more, and the community aspect I think is really neat. I've already started sharing, as we're coming through earnings season, I've already started sharing some insights and notes on the portfolio that subscribers, that's the only place you're going to see them. So it's a place to get really clean, unfiltered conversation about those companies and our investing process, completely separate from all the other stuff we do. That's one of the cool things about it. All right. I feel like I'm shilling right now, so I'm going to shut up.
No, I'm glad you highlighted the community aspect, because that's the part I'm actually most excited about.
Me too.
That can grow over time. We can interact with people a little bit more. All right, Jason, as we start to think about the 3 things that any investor should know before buying their first or next stock, we bucketed them. It sounded weird when I said it.
It's a word.
Into 3 buckets, oddly enough. And the first one are some points around understanding markets. We feel like if you're going to be an investor, if you're going to start buying individual stocks, it's important to just understand the way the stock market works. All the stuff that I discovered as I got obsessed with this a few years ago, and you discovered a longer time ago than that. But what are some things you think, as it pertains to the markets generally, that investors need to know before they get started?
I think as a starting point, And I'm going to reverse the order of that we put these on our outline internally. So again, I'm saying the things out loud here,
I think
but
this gives people like an insight into it's like behind the
yeah,
scenes information.
yeah,
So maybe it's a good thing. We should
right.
do more of that.
I think the biggest thing is that you absolutely have to come into it both with the understanding and the ability to own stocks that can fall in value incredibly quickly and potentially by a lot. The great Morgan Housel has talked about that kind of that the reality of volatility in the stock market is the price of admission, right? When you're the owner, you have to deal with volatility of anything that's traded on public markets, and it can be brutally painful. And number one, having the understanding, right? The emotional understanding that it is a feature of investing in public markets and publicly traded assets and not a bug, not a flaw is useful. But you also have to have the actual financial ability to do it, right?
Yeah, yeah.
Um,
Those are those are 2 really important points. The thing I was gonna say when you were done, which was, like, it's the whole don't invest any money you can't afford to lose because you might. And
yeah,
the other thing I wanted to say as you were talking was about the falling of a stock being a feature, not a bug. I think that you have to know that, and that also that just because something does fall a lot in a short amount of time doesn't mean that it's a bad investment either. For example,
right.
just this past week, several of the stocks I own saw double-digit drops after earnings, and some of the best stocks I own in terms of, like, total returns over the times I've owned them have been stocks that have, at times, dropped 20% in a day. So,
Yeah.
it not only is it a feature, not a bug, it's also a feature of some of the best companies in the world. So that's another kind of twist to that that I think is important to mention.
Here's a neat little piece of trivia, Jeff, and I learned this with Datadog that just reported, and it's really fresh because that's a company that just reported the week that we're recording this episode. I went back and looked. That's one of the stocks that fell a pretty big amount after reported earnings, and since the beginning of 2023, so that covers 6 quarters that it's reported earnings. They've had a big earnings sell-off 4 out of those 6 quarters, Jeff. Here's the thing, the stock is up like 60% since the beginning of 2023. We always call it volatility when stocks fall, but you know what else is volatility? When stocks go up.
Mhm.
So you have to remember that.
Yeah, and I know referring to Amazon is an investing trope, but it didn't Amazon drop not in a day, obviously, but didn't Amazon have multiple 90% drawdowns over the course of its history, and it's been one of the best performing stocks of all time?
Well, not just Amazon. Look at Netflix. You'll see the same thing. Look at Alphabet, Apple. Yeah, these are great stocks, and we're cherry picking some big winners, but they do it right, and I think that's actually a good transition into the next point that I wanted to make. Great stocks aren't the only ones that fall a lot. All stocks do.
Yeah, the bad ones fall too,
The,
obviously.
the bad ones fall too, and this is the big reality: is that so you have the market average, right, which is that roughly 10% annualized rate of return. But the stock market almost never has an average year, right? So you never I mean, like over the past 15 or 16 years, I can basically think of 1 year that was around 10%. The market actually went up about 10%. It's usually up 25 or down 2 or up 17 or up 4 or whatever, right? It's you never actually see the averages. And as a matter of fact, most stocks, Jeff, a majority of stocks underperform the index, and it's not even close. So to me, that's to bring kind of a sports analogy in because we're so hardwired against loss aversion. This is maybe one of the hardest things about investing is we try to make every stock pick perfect. Then we look through our portfolio and we see, well, that stock's down 15%. The market was up 35%, but this stock was only up 28%. This stock was up 75%. Right? And then what do? We sell a bunch of the one that was up 75% and then reinvest it in those other ones. The reality is chasing losers to try to, average down is probably a bigger, especially when you're selling off your biggest winners to fund that averaging down versus just focusing on the narrow few that are actually the winning businesses. Because in the history of the stock market, it's just a narrow few that generate all of the alpha and that generate the vast majority of the total returns. It's just a narrow few companies. We forget that or don't know it. Nobody ever taught it to us. And we focus on watering the weeds.
Right. And, I think the statistic you always hear is, even a good stock picker is only right 60% of the time in terms of, individual stocks they've picked and their
Yeah.
ability to beat the market. And I think it's probably good to try to beat that if you can. Like that's like a goal, but it's not the kind of thing where, especially when you're new, it's not the kind of thing where you're going to pick 10 stocks and 9 of them are going to be winners. That's just not the way it works, which is a good segue also into our next point, which is that early success is probably luck as much or more than it is skill, right?
Yeah. If you came to investing in, say, the spring of 2020, Jeff's raising his hand for those that are just listening to the podcast. Like probably a lot of you that are listening to this, guess what? You were really lucky. You were really lucky that you fell into investing at the best possible time in the past half decade to see very quick feedback from the market about your in your head skill, right? Because again, that crazy round trip we saw with the stock market from the February 2020 peak to the bottom in late March to the gaining back all of its losses. I think it was like 9 months was the from the peak through the trough and then recovering all of the losses. Just a remarkable period of time. Something like 70% of stocks gained in value over that period. Again, the numbers prove out that doesn't always happen, right? So,
Yeah, and I
and
I
I have a
raised my
question
hand.
for you.
Yeah, go ahead.
Yeah, go ahead with yours, and then I'll ask the
No,
question.
I was gonna say I raised my hand because I was one of those people who misattributed my success to skill rather than
Yeah,
luck, and I
right.
was very quickly convinced otherwise as the market turned in 2022. But what was interesting about that particular period, it wasn't so much that the big winners won. I'll use Zoom as an example because that was the one stock I bought during 2020 and 2021 that went on just an incredible run. And I was mildly bragging to my friends who didn't care about investing, but it was the exciting, shiny thing that I was obsessed with that my Zoom stock was up, whatever, 170% from when I bought it. And I I want to say I was smart enough to know that that couldn't last forever, but at least there was a story you could tell yourself with Zoom that people would be doing online meetings forever and that growth could stay. What was more remarkable, I think, about that period of time in the market was everything went up. You could tell yourself a story about why
Absolutely.
Zoom went up, but it's almost everything else I owned on almost any day was going up. And that's the part I think that probably tricked a lot of people and had them think that they're the world's best stock pickers. And obviously that turned around. What was your question? What did you want to ask?
So I want to ask you, and this is a little fresher on your mind than it is for me, again, because of the difference of when I really started focusing on buying individual stocks and when you did, is there's definitely some positive aspects to early success versus early failure. And my question is for you, do you think netting everything out, your first 6 months or 9 months, let's say, as a stock picker, was that success beneficial to you? Or do you think it was more harmful over the next 6 or 9 months that followed it?
Hey, everybody, we'll be right back, but first, a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company specific segment and KPI data on more than 1,500 stocks. Want to see Netflix's average revenue per member over the past 10 years? FinChat's got it. Do you like to track YouTube's advertising? They've got that too. Want to see how much of Celsius's revenue comes from Costco? You guessed it, they've got it. The breadth of FinChat's segment and KPI data is truly one of a kind. I use FinChat all the time and I love it, especially for checking out the KPIs of all the stocks in my portfolio. To get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes. I may be an outlier to ask that question to, because simultaneous to me finding individual stock investing was
You found me.
a I found you and you
Yeah.
complete me. But simultaneous to that love story was also that I became very obsessed with the learning aspect of it. So it's hard to say. I don't know what the counterfactual really would be. I'd like to think that because of my obsession about learning about it and because I was using like embarrassingly small amounts of money, I might have ended up in the same place either way, had I started in a crazy bull market or a really bad bear market. But I think for the average person, especially someone who's younger, because I do think whatever mindset I did have 4 years ago was partially due to the fact that I was 40 and not 20.
Mhm.
But I think for most new investors, especially younger investors, like young adults who are just kind of figuring out the world generally, I have to think it's better to experience success first than failure, because when you don't really understand how it all works and you buy something and it goes down 80% in 3 months, you could very easily be like, "This is rigged. I'm done. I'm never doing this again. The stock market is only for, you know, certain people, and I'm not one of those people." And I could see how it could turn you off from investing entirely. I would hope it would only turn you off from stock picking and you would still have like, a mutual fund in your 401k or something so you can retire eventually. But I don't know, it's hard for me to say for the way I would have been, but I think for most people the answer would probably be to have early success.
Yeah, I think that's fair, and to your point, I think we're, thinking about this on the 2 extreme ends of the pendulum of, those early days of the pandemic as being such a perfect opportunity, and then the kind of the inversion of that really is October of 2021 for anybody that would be really concentrating into, like, cloud stocks or really high growth tech software as a service sort of businesses, because while the S&P 500 and the other like the Dow and like those big indices peaked at the beginning of 2022, like the first week of January of 2022, it was October of 2021 when the Nasdaq 100 peaked. So people that were really chasing those really big, super hyper growth investments that invested in that period lost a ton of money, right? Over the next 6 months, or really a year and a half almost. And while the S&P and a lot of those more diversified portfolios have fully recovered and marched to new all-time highs, those people never recovered. And again, but those are two extremes. And I think
Yeah.
kind of for me, the reality for most investors is you start out and you invest in 5, 10, 15, 20 stocks, and you have a couple that do really well or maybe do fine. And most of them are just kind of in the middle of the road. But then maybe you have that one or two that fall 50% or more, right? Just and that's the pain, that's the lesson where you don't deal with like permanent loss of capital, like people that would have started in that peak period and the riskiest, most overvalued cohort in the past 2 decades invested and have really suffered permanently, particularly if they've walked away from the stock market. You learn those 1 or 2 painful lessons with a little bit of success. So it's a little bit of the carrot and the stick. I think maybe that's the tuition that pays off the most.
So, as it pertains to our first thing to know before you buy your next stock or your first stock, which is understanding the markets, what is there anything else in this first one that you want to make sure we cover?
Yeah, this is something you and I talked a lot about last week, and we talk about a lot, and that's having goals, right? And defining your goals and separating goals from aspirations, because we all have the aspiration as stock investors of getting really rich, right? Let's be honest. We all hope we buy Amazon in 1997 and hold it, right? For 25 years. And we turn $1,000 into, $900,000 or whatever it's done, right? And instead of just being comfortable when we retire, we've got a couple extra $1 million laying around because we remember Netflix was out there and we bought that in 2002 also, right? We all hope that's what happens. But that's the aspiration, right? And we can't to crib your statement earlier about not risking what you can't afford to lose trying to get what you don't need. I think that's the key, because you identify your actual goals, and to me, the when is more important than the what. So, for example, retirement is a goal, putting your kids through college is a goal, maybe retiring early is a goal, right? Or buying that vacation home when you're 55, right? Before you retire. Those are all actual goals, but they're all just some future allocation of right? Funds the win is the thing, right? Your kid's in first grade, you've got 11 years before they retire, before they start college. You probably have 25 years from that same period before you're going to however old you are, right? Before you retire. And how long you have is more important to defining how you're going to allocate your resources to generate that wealth than whatever the hell it is you're paying for. So I think that is so important because that defines, how you're going to allocate your funds, helps you thinking about the first couple things we talked about the feature of the market is that stocks are going to fall. If you're investing for a goal that's 5, 10, 20, 30 years off, you absolutely have the capacity to hold through downturns, right?
Right.
Because you don't need to turn that asset into cash, right? You can ride through it. You can absolutely ride through it.
And I feel like that having a goal, knowing your goal, and we talk about this a lot, is absolutely part of our first kind of point here about understanding the markets. But I also think it's a big part of the second thing, which is understanding yourself.
Yeah.
And I think of this point, point number 2 of understanding yourself as being, I would almost subtitle the episode as, 3 things to know before buying your first stock. And then the subtitle being, or learning if you should be in index funds instead.
Yeah.
Because I think a lot of the understanding yourself aspect of what you need to know before you start is to determine whether or not picking individual stocks is right for you. And that's partially related to your goals. Because like you said, while we all want that great story to tell that we held Amazon for 30 years and it's up 10,000%, the goal is really to retire comfortably or to put your kids through college or whatever it is, right? And I think your that goal setting and also your mindset and your risk tolerance and all those things are the first like filter you need to go through to determine if this is right for you. I think another one in the understanding yourself bucket is you have to ask yourself what's your willingness to and interest in learning more about investing in individual stocks. It's not the kind of thing that you can do just mindlessly or by, you have to do a little bit of work.
Yeah.
And I think even if you're signed up for some,
Outside of periods like the spring of 2020, you can't just randomly pick stocks
right. Yeah. It's a
and
skill.
most of
It's a
them are
skill
gonna
you
go
need
up.
to work on for
Right,
sure.
right. You have to identify the ones that have the best probabilities of generating returns within all of the frameworks around what you're looking for. That is so important. Go ahead.
No, I was just going to say, and it's okay if that's not your interest, but it
Yeah.
also means you probably shouldn't at least not put a lot of your money into individual stocks. Like I'll give an example. I think if you subscribe to like a stock picking service or a newsletter and you want to dabble in stocks with some small percentage of your overall portfolio just cuz like it's fun, you're sort of interested, maybe you like the kind of gambling aspect of it. I actually don't think any of that's bad or wrong if it's an amount of money that you can afford to see go to zero if it does, because the chances are, if that's your approach, you're not going to be very good at it. You will likely lose to the market, and you will possibly lose money. I
Yeah.
think if you have any chance of beating the market, then you do have to put a lot of time in. And you and I are good examples. Like we put a ton of time and effort into it because we like it, and
Mhm.
I think we each do pretty well as investors, but I wouldn't say either of us is Warren Buffett. So it's like, even when you do put a lot of time in, the odds are probably, I wouldn't say stacked against you, but it's still not guaranteed you're going to win. Right. So I think that's like
I have 50 years to prove you wrong about that. So,
well, but I think that's a basic thing you have to ask
no, it is.
yourself.
It's true. It's
And if,
true.
and honestly, if the answer is no, go buy an index fund and relax for the next 35 years. You'll probably have more free time and less stress than you and I do, and probably be just as wealthy.
Yeah, I think that's
That's
right. Well,
important.
and I think there's a couple of things to build on it too. I think you're 100% right that if you don't enjoy it, right? If you don't enjoy the pursuit, if there's a lot of intellectual pleasure you can get out of doing this too, right? You learn new things, you get to explore exciting industries or maybe boring industries too, as far as that goes, right? But you get to have some intellectual pleasure out of that pursuit, which I think is maybe underappreciated by a lot of people that are trying to create wealth. But I think there's another thing too. Like you can, if you have a special skill, if you work in a high growth industry where there's opportunity, and you have special knowledge, I think there's absolutely an opportunity to try to leverage that. Maybe most of your investments are still in ETFs, but because of your special knowledge, maybe you work in some field in technology, you can take 10% of your wealth and you can turn that into outsized returns. But if you're wrong about a couple things because you're blinded, you're not creating like existential risk to your family's wealth, right? That's another way to do it. You mentioned some like the stock picking services out there. I have two schools of thought about it. I think number one, it can be a great jumping off point for research, kind of the top of your filter of finding great ideas. And then you can take that and have that more narrow focus if you have less time to take their 10 best ideas and find the ones that you think have the most potential or they fit your portfolio. And again, you're not just reading their research and then throwing, just being a chimpanzee throwing darts at a dartboard here. You're actually doing further research, right, with it. You're using it as the starting point for your research, or you buy the whole damn thing and you set it and forget it. You trust them, you buy it, and then the next month or the next quarter, you just do it again. And they're providing research and transparency about their results. So you have the ability to see it, but you're not looking at the portfolio every day and second guessing and judging every stock based just on the stock movements without actually doing any damn work yourself.
Right.
I think that's another way that you can go about it.
Well, because if you hire a money manager, that's essentially what you're doing.
Right. Exactly.
You're not hiring a money manager to second guess their choices. You're saying, take
Right.
all my money and invest it. And,
Right.
this is just like a lower cost way to do that, where you have a little bit more transparency and a little bit more ability to do your own research.
Yeah. I think there's one other point I want to make about this too that I think is important. Figuring out about that willingness to learn. Another part of it too is figuring out your willingness to deal with the volatility, right? So we talked about this a lot. I do think one of the best ways to inoculate yourself against selling a winner because you're afraid that it's going to start falling and you don't want to, you don't want to lose out on those gains, right? You want to sell the top or whatever. And just as much as avoiding selling a stock that's gone down, that the business is still perfectly fine. Like I mentioned DataDog as an example, right? Yeah, you had 4 out of 6 opportunities to sell because it looked like it was in trouble or it had topped out over the past 18 months, when the reality is that this is still a great business that's going to grow. But if you don't know anything about the business, fear takes the wheel and you sell. So it helps you inoculate it. But if you just find out that you're not wired to be able to do that, you know what? The ETFs are a great way to invest because you know what? We talked about Amazon and Netflix and those big drawdowns they've had in the past. You buy ETFs, you still have exposure to those businesses, right? Those few that generate most of the returns, they still do it inside ETFs. You just don't have the individual risk of owning a concentrated portfolio of just those individual stocks. And you won't screw up the good ones because you can't see the good ones because they're masked inside the ETF and you just see the total returns.
Agreed. And I think kind of related to this, but maybe a little bit differently, or it's at least related to an earlier point we made about goals versus aspirations. And it falls into this bucket of understanding yourself, which is a question you need to ask yourself is, are you willing to get rich slowly?
Yeah.
Because I think what draws people, a lot of people get drawn to individual stock picking at the beginning because it's FOMO. You hear about a friend who bought this stock 6 months ago and it's doubled. You're on Twitter and you see all the rocket ship emojis next to the stock tickers from the people who are touting their success as investors. And by the way, they'll be very quiet when their stocks go the other way.
Hey, Jeff, congratulations about Outset Medical, by the way.
Thanks, man. But honestly, if you're not willing to say to yourself, it takes a long time to build wealth, then
Yeah.
it's probably better again just to DCA into a dollar cost average into an index fund and not be actively into it. Because yes, it will happen to you at some point. It's happened to me and I've only been investing for 4 years where a stock has gone up a lot in a short amount of time. My Nvidia position is up 365 something percent and I've only owned it for 4 years. Now that is not a brag because as I said before, I think it is at a total of $500 total money right now, which tells you how small of an amount I started with. But and that is if that were 10 times that amount for me, I would be very tempted to not only sell that and use the cash for something, but I'd probably think I'm more of a genius than I am. And that I would have to stop myself and say, this has been great. And maybe I will at some point sell something on the shorter side and use the money for something, but that is not my goal here. I am very happy to get rich slowly and over the next 10, 15, 20 years that I continue to work and not worry about it for a while.
Well, again, using the idea of a bell curve when thinking about human temperament, this is important because understanding yourself and it not being binary, where you either need to be all stocks or all ETFs. There's a broad range of how much of your portfolio you put in individual stocks versus you put in more diversified assets that's between 0 and 100 and 100 and 0, your mix. But so much of that is about understanding yourself, your time availability, your willingness to work. And the big one though, like you were talking about, Jeff, is, and we talked about it, is the idea of being patient. And that's part of it, right? Patience and willing to play the long game for delayed gratification. But it's really just temperament, right? Understanding your temperament, because you can't just change your temperament, but we talk so much about frameworks. And this is what I've really come to understand over the past year and a half, Jeff, is the idea of frameworks. All of the thing that your framework is built around is optimizing for yourself, right? How you process information, how you respond to positive and negative stimulus, building in friction to limit the self-harm, which I think is more important than any other aspect of being kind of an amateur investor for anybody that's not being paid by somebody to invest money for them or 100% earning your income off of investing your assets. You have to build in processes to limit self-harm first, and then your framework can leverage the things that you're actually talented at next.
Hey, everybody, we'll be right back, but first, a word from our sponsors. Earlier in the show, you heard us talk about investing platform public.com. That's where you can trade options with no commissions or per contract fees, and you get a rebate of up to 18 cents per contract traded. NerdWallet recently gave Public 5 out of 5 stars for options trading. If you want to see why, go to public.com and start getting a rebate of up to 18 cents per contract traded. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures in podcast description. U.S. members only. I think I know that this isn't part of what we sketched out in our outline, but what you just said about frameworks and knowing yourself got me thinking
Listen
too.
closely here, people. Bonus content.
Bonus content behind the scenes. No, but I think it reminds me of the fact that you have to know yourself in terms of the way you're going to do the work you need to do to learn about stocks. So, for example, the running joke on the podcast is my nerdy spreadsheets and the fact that you write almost nothing down. But that's because that's you as an investor. You have, and I'll give you a compliment here. You have a very good, from what I can tell, just memory of things. Like you'll remember, oh, 3 quarters ago, this company did that. And that's not the way my brain works. I need to put it down somewhere and then go back and look at it. And that might jog my memory. I might be like, oh yeah, I remember this happened to that company 3 quarters ago. But I think in terms of frameworks and knowing yourself, this will be the last point on the understanding yourself part of this. That also feeds into how you're going to allow yourself to learn and follow companies as they report quarter after quarter. All right. So the last step here, if you've already if you already learned how to understand how the markets work, if you've learned how to understand how you work, I think the last step is there is a degree to which you just need to understand financials. You have to understand a little bit of accounting. You have to have a basic math understanding. You have to understand how businesses work. And I'm curious what you think is the most important thing here. I think you really need to spend the time to understand your way around the 3 big financial statements that get put out by companies every quarter that are audited. So the cash flow statement, the balance sheet, and the statement of operations, or P&L, it's called sometimes.
So those are only audited annually, Jeff.
Okay, I apologize. They are out every quarter and only audited annually. But knowing your way around those and how they are organized and what all the lines on them mean is not rocket science, but it does take some time to dig in and learn it. But it is a wealth of knowledge and information. And I think for me, because I nerded out on that kind of early on, and I feel like I learned a good chunk of it quickly. Still a lot I need to learn, but I got to a point where it was like enough to be dangerous. For me, it was like eye opening because there's a high degree of pattern recognition when you look at those statements a lot over and over again, either the same companies quarter after quarter or even different companies quarter versus other ones. So I'm curious what your thought is on the degree to which it's important to understand accounting, financials, and specifically those financial statements.
Yeah, so I love what you just said about knowing enough to be dangerous because this is like a reality for investors. Once you get some basic understanding, then you turn into a bull in a china shop, like a really, really, really like cocky bull in the china shop too, because you read these things and you start thinking, well, all right, I know what a price to earnings ratio is now, and I know what a company that has a lot of debt looks like. And then you start misapplying some of these things across different industries and sectors where a balance sheet or a cash flow statement might look very, very different. Margin profiles might look very, very different. I want to give like an example of that, Jeff. Two companies that are very, very different. Starbucks, retail business, massive buyer of her products, focused on consumers, gets super duper high margins on the front end, uses a lot of technology, has used some debt, but is not super high leverage. And then compare that to like Brookfield Infrastructure Partners. It's infrastructure, it's boring, it's slow growth, uses a ton of debt to acquire these assets, paying a dividend. It's becoming a bigger deal for Starbucks, but for Brookfield, it's always been a big deal paying the dividend and growing the dividend. If you were like a growth investor back in 2010 looking at Starbucks and somebody said, "Hey, look at this Brookfield company," you'd be like, "What is that garbage? They own wastewater treatment plants and toll roads. Why would I look at that? They got all this debt. Why would I want to buy that?" They've both since Brookfield went public, it went public in 2007. Starbucks have been public longer than that. They've both generated like 820% in total returns, right? They've both been incredibly like market, more than doubled the market over that time. Wonderful, huge winners. But the way you analyze the businesses is very different. So,
Yeah, and you're
um,
gonna see very different things on those financial statements for those 2 companies. If you
right.
tried to compare them just based on that, you'd get confused.
Yeah, absolutely. So I think that's a really important thing too, is like taking the initial under like financial knowledge that you have, and then being willing to be humble about the fact that you don't know everything and that you need to apply different filters, looking at different industries and different companies, and even different companies in the same industry, depending on where they are, maybe in their growth profile or how they're looking to do it. Like disruptors, a lot of times do things in a very different way than legacy companies do in an industry, and you have to kind of have that imagination. So probably the humility aspect of understanding financials and realizing you don't know 95% of it versus just applying the same lens to everything that you look at, because you miss so many opportunities when you do that.
Yeah, I agree with that entirely. I think the knowing enough to be dangerous aspect, I think what's encouraging about if you look at these financial statements for the first time because you're a new investor and they're intimidating to you, I think what's encouraging is getting from zero knowledge to enough knowledge to start making some informed decisions doesn't take an incredible amount of time. It's getting beyond that that does take a little more digging. There's a really good book, and by good, I mean incredibly boring at times, called How to Read a Financial Report by an author called John A. Tracy. You can just Google that, or if I remember, I'll put the link in the show notes. And it goes
I will definitely always put links for books
in
in
the
the
transcript.
transcript.
Yeah.
So sign up at investingunscripted.com for our newsletter and you'll get the transcript in your email the day the episode comes out. You can find the link right there too.
But I found that book after I had what I would consider to be a basic understanding of those financial statements, and it really, really solidified a lot of good things for me. So if you've not really understood those and want to do a deep dive, that's a book I would recommend. But like just as an example, Jason, like when I learned that the statement, the income statement is basically like a funnel, right? Like the revenue is the top of the funnel and earnings is the bottom. And
Mhm.
learning that like you take revenue, you subtract cost of goods, you get gross profit. You subtract your operating expenses, you get operating income. You subtract interest and other stuff, and you get earnings, right? Like that basic
Right.
structure that it's just like cascading down towards the bottom. That's why it's called the bottom line. I just heard it explained that way in a more elegant way than I just put it, and I was like, oh my God, that makes so much more sense now. And then you start connecting, well, how does the income statement can actually connect to the balance sheet and the cash flow statement? Like, where do
Right.
these things show up on the other things? So
That's so important, right? The difference between like an income statement and a cash flow statement,
very
because
different. Yeah.
net earnings is not how much cash the business generated at the end of the period. Cash flow and income can be very different things depending on the industry and the business.
Right. And then you start making connections. I think what also helps newer investors is to make the connections between your own personal finances and business finances. So I think cash flow makes sense to a lot of people because we all know
Yeah.
like how much cash is in our checking and savings account. And some of the gap accounting can be a little bit more wonky because it's, you know, there's not much depreciation and amortization in our personal finances and things like that. You don't take goodwill write downs on your checking account. But
Right. And you don't recognize revenue, right? That's
right.
that's that's like
Yeah.
that's a big one.
You don't have accounts receivable and payable, so that kind
Yeah.
of a
Well,
thing.
I mean, you kind of you
But
kind of
yeah, I
do,
guess you kind of
right?
do.
You
You
kind of
kind of do.
do. But I think that's the key, right? I just want to say a little bit more about that because just to give people a taste of how important this really, really is. So you think about, we talk a lot about like the cloud companies and the tech software as a service companies on the videos we do, and also on the show when we're talking about earnings and companies that we really like. Is a company may take an order for a 12-month contract, and they may have a deal where the company prepays for a full year of services, right? Well, guess what happened? They just got the cash flow, but they can't actually recognize the revenue until they provide the service or the product that's related to that revenue, right? A customer may pay a deposit for $1 million in goods that's going to be delivered next quarter, and maybe they pay 20% down. You get that $200,000. You get the cash right now, so that's your asset. But you know what you have on your books? You have a liability now too, to provide the good or the service to that company at some point in the future. And then you recognize the revenue later, right? Well, okay, you recognize the revenue, you run everything through that filter, cost of goods sold, all that kind of stuff, and you get the profit out the end, but you've already gotten the money or a portion of the money, right? So being able to follow the nuances of cash flows versus revenues in the operating statement are so important to being a successful investor.
Yeah, and there's one more thing that's related to this that I wanna touch on before we wrap up this part of conversation, and that's there's the gap accounting, which is generally accepted accounting practices that's standardized, that shows up on these income statements and cash flow statements and balance sheets. Then there's adjusted things that companies will often put in press releases and sometimes even in the 10K and the 10Q to give what they think is a different view of the business. And that I feel like is the transition point to what is a lot of times company spin and not reality.
Yeah.
As soon as you start adjusting anything, there's no standardization for adjusted anything. So adjusted EBITDA at Jason Corp could be very different than adjusted EBITDA at Jeff Corp.
And
And
that's so important, right? Because EBITDA is technically a non-GAAP metric, because what it is it's earnings before interest, taxes, depreciation, and amortization. So if a company says, "Here's our EBITDA,"
that's already
it's
adjusted.
well, it's
It's
non-GAAP, but
non-GAAP.
it's
Yeah.
but it's not adjusted, right? So that's important. So if
Oh, yeah, yeah,
if
yeah. Yeah.
if Jason Corp says my EBITDA last quarter was this, and then Jeff Corp says, "Well, my EBITDA was this,"
That's
we're
already
giving
not the
you
same
the
thing.
same number.
Oh, yeah. Yeah, yeah, yeah.
But it's a non-GAAP number. Now, if Jason Corp says our adjusted EBITDA number was this, and then Jeff Corp says my adjusted EBITDA number was that, we may or may not be giving you the same number depending on the adjustments. That's so important to remember.
Yeah. And you'll
Jason
see
Corp never adjusts stock-based compensation, by the way. Jeff Corp always adjusts it.
always adjusts for stock-based
Always.
compensation. And
Yes.
and look, we don't need to go into the weeds on this in case there's some like actual beginners listening who are just confused by these acronyms and stuff. But the point is, there's a lot of company spin in press releases and in
Yeah.
earnings calls. And I think this is tied to understanding financials. The reason you want to really understand the gap accounting and how it works on these financial statements is because it's a filter for all of the stuff that management's going to tell you
It's a
about how
bullshit
they're
filter.
it's a bullshit filter. That's a good way to
Yeah.
put it. Yeah.
Yeah.
Because,
Sorry,
the
kids. Mom and
exec
dad will explain what that word means.
the executive team's job is to present the company in the best light without lying.
Right. Right.
And
Well, it's real simple, Jeff. The 10Ks, which are your annual reports, your 10Qs, which are your quarterly
quarterly.
financial statements, and then the 8K, which is a report, an unscheduled report of material information, like a press release or a presentation or something like that. Those are filings with the SEC. Those are disclosures. Okay. They're disclosing and filing required information with their federal regulatory body, right? So this is what happened, right? All the presentations, the press releases, all of those things, those are what management wants you to focus on. So
Yeah.
think about it that way.
Yeah. And there's some tips and tricks we've talked about in the past. Like if a
Yeah.
company reports something that's non-GAAP, because that's optional, whether if, for example, subscriber numbers, you don't have to give out subscriber numbers if you're Netflix, but they do. Actually, they're going to stop, right? What's the one they're going to stop doing? Is it total subscribers or something?
Who knows? Yeah.
Anyway,
I think an important part of that, Jeff, is that we're not saying to and now our good friend Tyler Crow would say, ignore everything that they tell you and just focus on the filings. And I think that's unfair because the reality is a lot of like the KPIs, the industry specific metrics, a lot of those things they're not gap and and the companies can change what they tell you at any given time.
and that's something to be wary of, I think. That's a
Yeah.
yellow flag.
Yeah.
If they always report this metric and then just stop.
Right. Especially if said metric has been deteriorating over prior quarters and now they
Right.
say, "Oh, well that's not as important now. So we're going to tell you about this other thing." Always be leery of that, but the point is that it's not binary. Just like the best lessons aren't learned in bull markets and the best lessons aren't always learned in bear markets. The reality is that these are all things that can be incrementally valuable and you use them together and you never just trust what management's telling you. You want to verify it with there's what they say and then there's what the business does. And what the business does is always going to be in those quarterly and annual filings.
Yeah.
And some of the good stuff's going to be in the presentations, but also those presentations and the press releases and the earnings calls can help you hold management accountable because that's what management says. This is what we expect the business is going to do. And then you can look back in 6 months or a year or the next quarter and say, well, did you?
Yeah.
And if they did, great, or they did better, even greater. But if they didn't, then what did they follow up with? And you find out who you can trust. And you also find out if your thesis is right, right? Is the business actually doing what you thought it could do? Because you don't want to, like, I think sometimes like businesses don't deliver and then we just get mad at the management. And maybe the reality is, you know what? I thought this would be a great business. And you know what? It's a fine business. The potential is just not as good as I thought it was. So maybe it's time for me to just start looking elsewhere instead of hoping to hire a new CEO who's going to fix the broken business. And maybe the business is just what it is. And we're the broken investor who keeps trying to make it a great business in our heads.
Yeah. And I think what's interesting, and maybe this is a place we can wrap up this part of the conversation, is
Yeah.
that there are companies out there that all companies give varying degrees of detail in their earnings report. So there are some companies that literally do nothing other than release the SEC filing. And the most famous example of that is Berkshire Hathaway. With the exception of the annual meeting and the letter he writes, you get
They,
no
they
other.
make up for it once a year, right?
Right. But you don't get any, you don't get a press release, you don't get a,
No
you don't
calls
get a
with
conference call.
analysts. Right.
And there's other companies that are like that. Winmark is like that. Boston Omaha is like that, much to the chagrin of me and you. But in a way, it forces you to start to do your own analysis to try to figure some things out. And I think that's actually sometimes a good thing because you can't be spun by the spin because there is no spin to spin you. So the bottom line is, as we wrap up, you need to understand financials before you start, before you make your next or your first stock pick, at least to a point where you can know enough to be dangerous, to use my earlier quote. And over time, I think it's in your best interest to learn even more than that, if for no other reason, to give you a pretty good BS filter for what management's going to throw at you. So Jason, just to kind of recap, the three things that we think all investors need to know before buying any stocks is you need to understand the market, you need to understand yourself, and you need to understand financials, how businesses work, and that kind of thing. Any final thoughts as we wrap up here?
You're always going to be improving in all three of these things, right? I think that's the most important thing to remember.
That's a good point. Yeah.
You're going to be building on your knowledge. You're going to become more experienced. We've talked about before that the idea that people rise to the moment, especially I think when it comes to investing, is absolute nonsense. You fall to the level of your training and your knowledge and your experience. And that's certainly going to happen with the first and the third things, understanding the markets and increasing your financial wherewithal over time. But also you're going to evolve as a person too. And your understanding of yourself, even if you don't really change a lot, right? You just kind of distill down to more and more of like who you really are. You understand yourself better. And here's the important one, Jeff, last thing I want to say, and I want to give you the last word on this, is that you'll understand how you're like within the framework of yourself and the framework that you build around your goals and your money and your finance and your wealth, like how all of those things intersect so that you do become more effective allocating your wealth to reach your goals and become a better steward of your family's finances. You just get better at that, right? You get better at understanding how all of those things intersect over time. And it really, really pays off. And you kick yourself because 10 years from now, you're going to look back and like, man, I was such an idiot. And right now you're probably thinking there's your genius. And that's just the reality of it. So that's how I kind of think those three things work together. What about you?
Well, I totally agree with that, that these are all things that are not static, and it's ideal to know all three before you start, but certainly if you don't, or if you know them to some degree, you'll learn more over time. My closing thought is that these three things, knowing the markets, knowing yourself, knowing the financials, if you're listening to this right now in May of 2024, these may not seem like totally vital to you, but I guarantee you, if you listen to this episode during the next bear market, or if this episode was out there in 2022, it would absolutely feel more relevant. And I think my takeaway is that these are the things you should know at all times, but you will really be happy you know them when we're going through a bear market, because everything will feel like the wrong decision. Everything will feel tougher. Go back and look at some of our episodes from 2022. It's mostly my financial therapy on the air. So that's my takeaway, that these are not only skills you're going to learn more about over time, like you said, but that these are really going to come in handy when the market is not going in a good direction.
Because they're going to help you avoid the mistakes. And like I've said before, the older I get, the more time passes. I think that is the most important thing for investors, is mistake avoidance. So I love that, Jeff. That's great final thoughts there. All right. I think we did it, buddy. We did it.
We did it.
All right, friends. As always, we love sharing our thoughts, giving our answers to these hard questions about investing, stock picking, knowing how to read financials, and understanding thyself. But thyself needs to understand thyself, and thyself can't borrow our ideas forever. You got to make these answers up. You got to figure out these answers for yourself. You are you, and you can do it, you. Hey, you. I believe in you. Okay, Jeff. We'll see you next time, pal.
We'll see you next time.